If you have been feeling that the ASX share market is not what it used to be or what it should be, and that it somehow seems rigged, but you can't explain why, then this video is for you. Research has now comprehensively proven that algorithms are able to rig prices, but more than that, it takes place on the ASX in daily trading. The manipulative fingers, of course, refer to artificial adjustments to prices forced by automated algorithmic trading programs, and which, according to the Corporations Act, happen to be illegal. To understand how algorithms rig prices, an understanding of the Corporations Act is required. In particular, Section 1041A. Section 1041A prohibits conduct which has or is likely to have the effect of creating or maintaining an artificial price for trading in various financial products, including shares and futures. The stock market provides a pathway to be able to access much of Australia's wealth. In public companies, share prices are established in the marketplace through competition between the genuine forces of supply and demand. If you can interfere with these genuine forces and prevent them from providing fair price discovery, then you can set up profit opportunities both in daily trading and over the longer term. It is the systems of algorithmic trading and short selling that enable the natural market forces to be bypassed. Rigging prices in daily trading sets up opportunities to skim small profits from mispricing, and small profits repeated over and over then amount to very substantial gains. There is a big industry that focuses on this aspect of trading. Over the longer term, the ability to impose severe undervaluations on stock prices lead to corporate opportunities such as cheap takeovers or access to cheap assets through forced liquidation. Profits flow freely when prices can be artificially managed. It is why we have a law, Section 1041A of the Corporations Act, that bans the setting and maintenance of artificial prices. The seriousness of the matter is why breaches of Section 1041A are regarded as criminal offences. A case in the Australian High Court mid-2013 provides the background to understand the manipulation that takes place with algorithmic trading programs. The case is referred to as the DPP versus JM matter, which can be obtained through a simple Google search. The landmark decision handed down in the DPP versus JM matter clarified that artificial prices result when prices arise through forces other than the genuine forces of supply and demand. That's the key point. The High Court also clarified that genuine sellers strive to maximise the proceeds of sales. And in relation to Section 1041A, the High Court stated that it is sufficient to show that the forces that formed prices were other than the genuine forces of supply and demand, not that the prices themselves were artificial. So let's have a look at the implications for algorithmic trades arising from the High Court decision. Fraud surrounding algorithmic trading relates to orders that are broken into small parcels of shares and put through the market, with the small parcels being programmed to cause large numbers of falls in price. It results in minor sellers being able to dominate in setting and maintaining prices. Such selling is focused on controlling prices, not maximising the proceeds of sales. To illustrate, the following example of trading features selling by Commonwealth Securities or CommSec. The price chart shows Codeco Limited trading on February 26, 2013, where the share price was under pressure from just before lunch onwards. The CommSec sales by volume as shown, where orders were clearly split into tiny parcels across the day's trading. Most of them were worth less than $500 in size. We can look at the small orders in more clarity using a truncated scale and using the dollar value of the sale. And by putting in the $500 line, it's very clear that the majority of sales were less than that amount across most of the day. Not all CompSec sales resulted in a fall in price, and by using the downtick chart, we can see just those trades that caused a price fall. CompSec selling shows the attributes of a non-genuine seller, and that is not attempting to maximise the proceeds of sales, particularly in the section shown where the selling was influential in forcing price falls, as observed on the price chart. If we look at the statistics for that section of selling, CompSec sold just 3,020 shares, yet forced a fall in price 77 times. Yet later in the day, it sold a similar volume of shares, 2,782, without causing a fall in price, as shown. Perhaps that was a retail sale, whereas the others were algorithmic strategic sales looking to pressure prices. The patterns of selling show how small algorithmic sales are able to control or manipulate prices. The prices that result do not reflect the forces of supply and demand. Small trades by CompSec used to force price falls and to cap prices before the close also spell out market integrity concerns as well. CompSec wasn't the only broker whose trading appeared to be in breach of Section 1041A regarding the setting and maintenance of artificial prices. Selling by UBS Securities also contributed to an artificial pricing environment. If we look at their sales by volume across the entire day and compare the sales that caused a fall in price, their downtick chart. In selling only 42,876 shares in total, UBS pressured prices throughout the entire day, with just over 70% of their downtick trades being small trades less than $500 in value. Now, to summarise, streams of tiny algorithmic sales that reflect non-genuine selling conflict with Section 1041A of the Corporations Act. Such selling is clearly focused on controlling prices, not maximising the proceeds of sales. In markets based on the genuine forces of supply and demand, it is the major sellers, and buyers of course, who influence prices, not the minor sellers. Yet, it is minor sellers who dominate in setting and maintaining prices on the ASX from the selling perspective. The floods of small trades by minor sellers force artificial adjustments on prices, which in turn serve to create confusion and uncertainty in the marketplace. In essence, that is what is wrong with the markets in all stocks targeted by algorithmic trading and short selling. A small group of investment bank brokers flood the market with small, non-genuine trades that continuously make artificial adjustments to prices. It allows them to unlawfully achieve various daily trading agendas and also long-term corporate agendas. And it results in an utterly compromised ASX marketplace. And a few key points to be kept in mind for the slides that follow. Algorithms are able to rig prices, and the practice is very widespread. For the most part, it is decisions made by programming code that set prices, not the natural forces of supply and demand. Prices are pushed around as required, whether it be up, down, or simply capped over the course of the day, and it occurs over and over in all stocks targeted by algorithmic trading and short selling. Trading irregularities accompany the failure of stocks whereby billions of dollars have been stripped from the market on an annual basis. The impact of wealth stripping activity extends to the entire nation, not just the shareholders in targeted companies. And finally, investors have been comprehensively misled. They have invested in the market, whether it be personal investments or compulsory superannuation, and they have made critical investment decisions based on a market that is very substantially corrupted. The incredibly complex nature of algorithmic trading, and for that matter short selling, and the confusion and opaque dealings that accompany all aspects of these systems is why theft in plain daylight is able to take place in such massive proportions, as you will see with some of the research slides. And with the investing public mostly none the wiser. To bring to attention the problems associated with algorithmic trading, we begin with a case study concerning Kingsgate Consolidated through the years 2012 to 2015, a 4-year trading period. Over the 4-year period, 1.67 billion shares traded and prices slumped 94%. A disturbing statistic arising from intensive research into Kingsgate trading over the 4-year period is that trades under $500 in value, representing 0.7% of all selling over 4 years, produced 59.1% of all trades that resulted in a fall in price. Does that raise a red flag for anyone? If it doesn't, it should, because negligible levels of selling have produced almost 60% of all the price falls over the period. It's an incredible set of numbers. Such data confirms that prices were primarily directed by the decisions made by programming code, not the genuine forces of supply and demand as required by a true market. To further understand the problems associated with small algorithmic trades, a sample daily selling profile is provided. The entire day's trading is represented by a chart that assesses trades less than $500 in value that have resulted in a fall in price. A fall in price is referred to as a downtick. The profile records the selling volumes of these small trades as a percentage of all selling. In the sample chart, 1.6% of all trades on the day were these trades under $500 that caused a fall in price. And secondly, the chart records the number of downticks associated with these small trades as a percentage of all downticks. On this particular day, it was 88% of all price falls arising from these small trades less than $500 in value. These small trades represent negligible selling volumes overall, but they dominated in causing price falls. The situation is completely contrary to the laws of supply and demand, which the market is meant to rely upon to deliver fair price discovery. The trend of small trades dominating in causing reductions in price each day was consistent across the entire 4-year period reviewed. In other words, daily trading irregularities were the norm. Now let's have a look at what daily selling profiles look like for Kingsgate Consolidated each day over the 4-year period. So here we have the chart of daily selling profiles spanning 4 years of trading, and pretty much each and every day, minimal volumes of selling generated the majority of price falls. An overall summary, once again, 0.7% of the selling associated with these small trades generated 59.1% of all the price falls that occurred. Astonishing statistics. Only in corrupted markets do negligible volumes of selling, and for that matter buying, get to dictate pricing outcomes. The impact for Kingsgate shareholders was devastating. As indicated by the price chart, showing a 94% decline over the period, all accompanied by non-genuine trading. And also an aggressive open short position chart shows that short selling was a contributor to price falls as well. There is always lots of conjecture that attempts to explain or justify share price movements, but news events and public commentary doesn't justify manipulative trading. And the trading data alone points to a comprehensively manipulated share price for Kingsgate Consolidated. And as it happens, the anomalies in many other companies are even more pronounced than the situation for Kingsgate. Manipulative trading behaviours coincide with a fall in market capitalisation of $1.02 billion. Kingsgate was forced into years of listless trading following the share price takedown. And again, the presentation only focuses on trading issues, not news-related issues or conjecture that might have ran in the background. Effectively, the system has allowed Kingsgate shareholders to be robbed blindfolded. And to make matters worse, justice has been suspended, particularly as fraudulent trading behaviours, in particular the setting and maintenance of artificial prices, have been blithely accepted by regulatory authorities. An easily manipulated share market is extremely damaging to the Australian financial system and the Australian economy. It facilitates massive amounts of wealth being transferred from the pockets of Australian shareholders, with much of it being drained offshore. Research has spanned a number of ASX companies, and in each case, the results have been more or less identical. A sample list of some of the companies that have been researched is provided, and rather than go through them one by one, it's simply worth pointing out that each has been investigated for a considerable period of time, and negligible volumes of selling associated with small trades have dominated in causing price falls. The problems are systemic. To assist with understanding what takes place with algorithmic trading, the following slides provide some deeper insights, again using Kingsgate trading as an example. Daily selling profiles provide an overview of trading and pinpoint where there may be market integrity concerns. To drill down deeper, it is useful to observe the impact of non-genuine sellers on prices, and that can be done by displaying their downtick trades next to a price chart. Trading in Kingsgate on May 6, 2013 provides a case in point, where small non-genuine trades had the effect of restraining prices as the share price was attempting to rise. The price chart shows volatile trading with prices dipping, then rising early, then being taken down, and then struggling to recover across the remainder of the day, mostly capped in afternoon trading. Broker UBS Securities was a comparatively minor seller on the day, accounting for 5% of all sales, but their selling nevertheless caused 40.1% of all price falls. The selling by UBS Securities is shown by dollar amount for each trade, and selling was spread out across the entire day but petered out towards the close, as you can see by the reduced values of trades on the right-hand corner. The smaller trades are more clearly observed when the scale is truncated to $600 rather than $14,000, which it currently stands at. So with the truncated axis, we can see that over 80% of the parcels of shares sold by UBS Securities were for parcels less than the $500 line as shown. Not all sales caused a fall in price. The ones that did, their downtick trades, were as per the following chart. So these are their downtick trades, and mostly of small value. 86% of the down tick trades were below $500 in value. And many of these small trades served to cap prices. As you can see, with low value trades across the bottom here, having the effect of limiting price rises, capped price in the price chart. UBS Securities had a dominant impact on prices despite it being a comparatively minor seller. Their selling program generated trades that controlled prices with seemingly scant regard for maximising the proceeds of sales, as required by a genuine seller. The effect on prices is very clear when price movements are compared to the UBS downtick chart, this time showing downticks in terms of the drop in price measured in cents. The previous chart showed the value of each downtick trade, and previously the value of the trades towards the close were quite small, but they did have a significant impact on prices, as you can see with the effect that prices were capped at the close. UBS downtick trades under $500 represented 0.3% of all selling, while accounting for 34.4% of all price falls. It represents minor volumes of selling that had a disproportionately large impact on prices, whereby the laws of supply and demand were effectively sidestepped. The problem is that large sellers in the market, and for that matter the large buyers, the dominant players, they're the ones that are expected to determine prices in a natural market, not the minor players as occurs on the ASX. While 81,501 shares were sold by UBS Securities across the day in active trading, the bulk of their selling, 59,000 shares, were for parcels in excess of $500, and these trades resulted in just 12 downtick trades. However, trades under $500, 22,352 in total, involved 269 separate small parcels and resulted in 73 price falls. By splitting orders into small parcels, UBS was able to obtain vastly increased leverage towards controlling prices. Splitting orders into small parcels creates large numbers of opportunities to continuously impact prices. It enables prices to be controlled to suit trading objectives. Can you see what is playing out here? Being able to artificially adjust prices enables all sorts of trading strategies to be optimised. But there is a small problem. Non-genuine selling behaviours are illegal as per Section 1041A of the Corporations Act. It's not a small problem, it's a huge problem. As demonstrated previously, Kingsgate is not alone, far from it. The ASX is littered by companies where corporate opportunities have been set up by long periods of manipulative trading. The prices of targeted companies are locked into an algorithmic straitjacket. Usually, the end result is characterised by a grossly undervalued share price, corporate activity seeking to capitalise on the company's misfortune, either through an opportunistic takeover bid or bidding for cheap assets through a process of administration and receivership. And finally, extremely angry and frustrated shareholders that the system simply ignores. Analysis of trading data has confirmed that the entire process begins with a heavily manipulated share price associated with non-genuine trading behaviours. Turning to the list of ASX companies for which research has been conducted, it is worth noting that while some companies are currently experiencing difficulties in the market because of manipulative trading, Meyer and even Harvey Norman are two examples. Many have been subjected to takeover activity, most of which has been successful, as pointed out on the left. Or they have collapsed and their assets have been or are being sold off. The amount of wealth drained from the system into mostly offshore hands amounts to tens of billions of dollars. And it all comes at an enormous cost, firstly through shareholder losses and then reduced tax revenues because of these losses. Foreign owners of Australian assets are also able to minimise their tax obligations so that revenues fall further. Lost revenues then results in the need for government to impose higher taxes and charges and cutbacks in government spending and services. It is ordinary Australians, not just shareholders, who ultimately pay the cost and suffer the inconvenience of wealth stripped from the share market. Ineffective regulation comes at a very high price. And to conclude, a couple of final comments. The share market has morphed from a system that supports productive enterprise and wealth creation to a system that has become finely tuned to enable the transfer of vast amounts of wealth from Australian companies and Australian shareholders into the hands of offshore interests. If you are a holder in a company that has valuable assets that attract the interest of predatory traders, there is virtually nothing you can do about the transfer of wealth that will inevitably occur. Poof, it'll be gone just like our background just went. The key problems are wide-scale abuses of the systems of algorithmic trading and short selling, and a regulator that fails to enforce the laws that govern the financial markets. And to conclude, a mention of the website asxinsights.com, which is attempting to provide some much needed transparency about the financial markets. Hope you enjoyed the video. Bye for now.